Hey, it's Matty Loans putting in work. It's November 2024, and I'm looking to connect with all of you interested on the latest news to help you borrow, buy, and build. We all know the Fed met last week, and to no surprise, JP and Company cut interest rates by a quarter point. That's great news for anybody looking to borrow money. Perhaps not today, but maybe next year, and the year after, and the year after that. We'll touch on that later. So, what does all this Fed speak mean to the mortgage market? That's the subject of debate on today's video. So, if you're borrowing money on a mortgage right now or looking to in the near future, it's time we take a closer look at the latest Fed speak. Truth of the matter is that the Fed only meets 8 times per year. So, when it does, it becomes the focus for financial markets. Often, these committee meetings get blown out of proportion, and some say the Fed's just following the 2 year. So, how much pull do they really have, and why are we hit up with all these headlines when it comes to mortgage rates? Half the time the Fed raises, mortgage rates go lower. And recently, they made a jumbo rate cut, and rates are up 1 point since then. So, what gives? Give the devil his due. The Fed matters. But remember, the Fed controls the short end of the interest rate curve. Think about auto loans, lines of credit. But mortgages represent the long end. Think about it. You're borrowing money for an extended period of time, 15 and 30 years, and mortgages truly react to different data. I'm not here to say that the Fed is not a brick in the wall, but there's always this presumption that when the Fed raises or lowers short-term monetary policy, that dials in rates across the board, mortgages in particular. So let's analyze the latest Fed speak beyond the quarter point and highlight three of my favorite questions from the presser that may give us clues on where we may see housing 3 and 6 months out from today. I'll humor you at the end with some phony headlines on what mortgage and housing may look like. Hopefully, you can sound off on the comments below and tell me if I've swung and missed. It's important to understand the Fed can manipulate financial markets beyond raising and lowering Fed funds rate. Yes, short term policy does matter directly to the cost of borrowing in relation to the yield curve, but Fed funds, it's only one of several ways. Two important others is forward guidance and asset purchases. Case in point, during the pandemic, mortgage rates continued to slide from 2020 through the end of 2021. But the Fed cut rates to zero by mid-March of 2020. Part of the reason why rates continued to slide was due to the outlook on inflation from the Fed and the Fed's push to buy mortgage-backed securities. Inversely, rates began to rise in 2022 based on new guidance and their decision to reduce their purchases of mortgage-backed securities. One of the telltale signs within the business was their appetite to reduce their holdings specifically for second homes and investment properties. During 2020 and 2021, it was common for the interest rates on a primary residence and a second home to have parity, meaning that they were just about the same, if not equal. In fact, interest rates for investment properties were only a little bit higher. There was such a tight spread, and it's not by the anomaly we see in the market today. Call any loan officer right now and ask for a rate quote on a primary residence. Then ask them with all the same stats what it looks like if you were to make it a second home. And then ask, what about an investment property? And you'll see very clearly that the rates for the second home and the investment scenario are going to be nearly the same, with a huge gap from what it looks like on a primary residence. The media likes to portray the Fed as the gatekeeper to lower or higher rates through short-term policy. But when the Fed cut rates in September for the first time in 5 years, mortgage rates actually went higher. Why did that happen? Obviously, it had nothing to do with the actual Fed move, but more to do with the prospect that rates may not be coming down as fast as we originally thought. And recent data from jobs and monthly inflation came in a little hotter than expected. Greater, I think, than any of us, including the Fed. When it comes to mortgage land, inflation is always the keystone. After the Fed cut rates, which some would perceive as a higher than expected 50 basis points, we saw job data, GDP data, CPI data, and the Fed's favorite PCE index surprise investors with stronger reads than originally forecasted. I can't debate the validity of the data. The job numbers are always revised, Meanwhile, the core readings on inflation were higher, but the headline readings did show improvement. So it's hard to say if this is good data, bad data, or maybe too much data that just muddies the water. Mortgage rates are hard to predict, and even the experts get it wrong. Don't believe me? Look it up. So I say we pull a Wolf Blitzer, go to the videotape from the latest Fed meeting, and see if there's any hints on where mortgage rates are going from here. Do you really have to fear 8% mortgage rates now that the Fed has started its rate cutting cycle? They cut by 50 in September, cut by 25 this month, and have their final meeting next month. In the lean right now, there's about a 70% chance for another 25 basis point cut. Part of the reason I think the Fed gets too much publicity when it comes to the mortgage market is that they're not a housing commission. Remember, they have a dual mandate. To quote from JP's opening statement, our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In words we can all relate to, that means an economy where everybody that wants a job has one with some predictability when it comes to the prices for goods and services. In the opening statement, Powell gives the Fed an A for effort and a B for results. In his summary statement, quote, inflation has eased substantially from a peak of 7% to 2.1% as of September. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and labor market can be maintained with inflation moving substantially down to 2%. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time. So it sounds like he's outdueled the dual mandate. The consumer's strong, businesses are still hiring, and inflation's way down. So do we really have any reason to worry about 8% mortgage rates? In my opinion, no, for several reasons. First, the Fed and its dual mandate require it to be a two-way player, right? It's got to deal with price stability and max employment as the focus. Now, 6 months ago, the Fed was not playing any offense as the labor market was tight, keeping wages up, but inflation was the main concern. But now it's time for the Fed to play some offense. Inflation's peaked from the 7% handle, and we get this reading from the PCE down to 2.1% in September. So the rate of inflation's way down. Now, it's not yet at the 2% goal, but they are driving it down. This is a good sign as mortgage rates will fall as inflation falls. And if the Fed's committed to 2%, we should expect mortgage rates to improve in the coming months. Mortgage rates peaked October 2023 when the 30-year fixed rate was about 8%. The only question remains lower, but how fast? Well, that'll depend on many things, but the Fed still says there's air to let out of the balloon. So we're not going to revisit 8% rates for at least what I think a very, very, very long time. Next, Powell states that the labor market remains solid, but lately, payroll gains, they've slowed. He mentioned several times in this meeting and the meeting before that the job market is more in balance and it's no longer overheated. In fact, in the September meeting, they decided to cut the rates by 50 basis points opposed to 25, I think partly due to the weakening labor market. A stat, they don't want to see any further weakening. The simple fact remains that employment has remained 4% or better since 2017. For the last 75 years, the unemployment rate has averaged 5.5%. So, by the long term trend, it would be hard to maintain unemployment at these levels. Now, during the pandemic, we did have a brief spell when unemployment shot up to 15%, but that was very short term. And since then, we've returned to a very low number for a very long time. It's hard to imagine now that unemployment's up over 4%, that it's just going to stop. Usually, when unemployment rises, it rises very quickly. Paying your mortgage bill can be a little tougher if you don't have a job. JP stated that spending has been strong with all facets of the economy, with the exception of housing. If you have a job, hopefully you can maintain your current standard of living, but it's hard to take the leap into housing when all your savings have been eaten up by inflation. Heck, even if you have the equity and you want to make a lateral move in this real estate market, your mortgage payment is likely going to be a lot higher, by about 60%. At least the pandemic was temporary. All the lockdowns have ceased. The only problem is that you're now locked into your home and loan for the balance of those 30 years. So it seems, but I'm sure that will change too. Just be cognizant of the lag effect with short term monetary policy. We've seen 75 basis points since the September meeting, but that doesn't change a whole lot for very many people. So rates are improving. But is there any part of home finance that benefits from this news? Yes, if you're borrowing money on a home equity loan or line of credit. For most people using these types of loans, it leverages the prime rate, which is now reduced to 7.75%. The prime rate is effectively 3% over Fed funds. So when the Fed cuts short term rates, it can help reduce your floating rate tied to your line of credit. Right now, it's not helping any first mortgage unless you may have an arm that's adjusted. The sum of the whole is that the latest Fed move isn't going to improve borrowing costs immediately or effectively. The bright side is we're past the hiking cycle, but it's not going to change the mentality or encourage any more borrowing, at least not now. We'll just have to wait and see when the Fed declares they've hit neutral rates. Right now, the Fed can't call where that is, but is aware enough to know they're not there yet. In respect to the so called neutral rate, he declares the current policy restrictive, which leads me to believe that we're in the very early innings of this rate cutting cycle. Moving to the presser, the first question I want to review is in relation to housing, not so much interest rates, but it comes from Kelly O'Grady from CBS News. How do you interpret these remarks to the cost of housing? Roland.
Just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
You're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better.
Powell responds that he doesn't blame how the people feel because he admits inflation never really goes away. The price increases that follow don't reverse. Your income just catches up. The assumption follows is based on price stability and with the respect that wages increase over time. Hopefully, they'll catch up to current prices. Housing prices, they may never. Inflation's been taxing. Everybody knows that. And likely the reason why spending is strong, not because people are buying a lot of things, it's because the things that they buy cost a lot. I think we all fall victim to the hope and promise that one day prices will return back to the pre pandemic levels, which I say without a catastrophic event isn't in the cards. Powell mentions it was a global inflation shift, and it will take years of real wage gains for people to feel better. Let's face it, housing it's expensive everywhere you go. California isn't the only place in America that's expensive. There are at least 24 other states right now that have at least one town or city where a starter home will run you 7 figures. With limited inventory due to this lock-in effect and the general lack of building, mainly due to production costs, it's hard to think that wages are going to ever catch up to home prices. If you look at home price versus inflation over the last 75 years, it's no contest. home prices exceed the rate of inflation by more than 1,000%. The best anyone can hope for is to actually qualify to buy something right now with the prospect that lower rates will prevail sometime soon. I'm sure we'll see some markets where housing continues to overperform and some of the hot markets, maybe like Florida, cool off just a little bit. But when you look at what a city like Detroit did for appreciation over such a short period of time, this is Detroit, remember. Are you really going to feel confident about buying something at 10% off when less than 5 years ago it was 50% lower? The next question that I really liked was from Chris Ruggenberg from the Associated Press. He asked if inflation by the Fed's preferred gauge, the PCE index, shows inflation right now starting with a two handle. Why cut rates? Watch this.
With the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress.
Powell admits the reads you're getting of 2.1 and 2.7 are the year-over-year stats, but they also look at the 3 and 6 month stats, which he admits there's going to be some variance, and doesn't get excited about the latest read or one reading that's out of whack. It's a fair point, and I appreciate the example he provides. He brings up that non-housing services, which make up 80% of the PCE, show that they're back to levels of 2%. These things are like utilities, your doctor visits, car rentals. Those are all back to the same wavelength they witnessed in the year 2000. The one thing that's not, which you can guess, right? This isn't any big surprise. It's housing services. You know, the rent. It's just funny to note that the Fed's preferred yardstick doesn't track housing in respect to home ownership. You know, mortgage payments, taxes, insurance, those type of things that really matter aren't part of the deal. They track rents based on the owner estimate. And what Powell's pointing out is that new rents, say that have rolled over from last year, are experiencing very little inflation. But it's those leases, maybe it was a 5-year lease or more, those are the ones that are showing huge adjustments. They're just catching up to the market. And this is the reason why we're still seeing inflation above the target range, and why I think the Fed will eventually deliver on the 2% target. The other thing he points to is that the job economy is not overheated like it was in the past. It's no longer a source of inflation, or what he says, inflationary pressure. So the inquiry asks about how far we've come, and Powell responds that we still have a lot of inflation to discharge. So if the pace of inflation is falling in most categories of the PCE, the job market's no longer a source of inflation, and the current policy is still restrictive, shouldn't the question be why we're only cutting 25 basis points? I'm a little confused, because is the economy working or not? If the economy's fine, why cut? If the economy needs improvement, why only 25 basis points? I don't think the Fed knows something, but it sounds like eventually they're damned if they do and they're damned if they do not. Powell mentions that timing's critical. Act too fast with rate cuts and it could set off inflation. Act too little and we could fall into a recession. I guess it's really a game you can't win. The most meaningful question, which was also from Chris, questions the so-called neutral rate and how far we are from it, which is the chief reason I think we go lower, a lot lower in rates, short term, long term, midterm. It looks like to me we've passed peak mortgage rates by a mile. And yes, they will rise and fall like any other commodity, but I'm expecting rates to be a lot better starting the end of Q1 2025. That's just my hunch.
So are you quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully. but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently.
It's noteworthy because the Fed can't define neutral, or at least doesn't want to tell us what neutral is. I thought the reason behind 2% was that it was neither restrictive or accommodative. Maybe he's being political here and doesn't want to rattle the market. But I think this is his Allen Iverson practice moment, or as Nancy Pelosi stating we have to pass the bill to see what's in it. All the Fed can tell us right now is that we're not there yet. It appears less of a game set by objectives, but rather a game of chicken. They're either going to be too early or too late. They're either going to get it wrong because the Fed doesn't have the golden touch. Remember, the Fed really works with a blunt instrument, cutting rates, purchasing assets. They don't work effectively and they don't work immediately. Then we've heard from other real estate moguls that says when rates fall into the fives, it's going to spur a whole lot of purchasing. Perhaps if all things are the same, jobs stay where they are, wages increase, home prices don't go up any more than they have, and we have lower interest rates at our back. Yeah, I could see a little bit more of it, but I disagree that 5% is going to set the real estate world on fire again. It's not going to change the market into a buyer's market. In my opinion, 4% is more of a neutral rate, but we'll have to see. So if we don't know what neutral is, how much improvement is on the horizon besides the 25 basis points next week? I think we've got a lot of improvement to cover, not immediately, but in the next year, the year after, and the year after that. So stay tuned to the monthly jobs numbers and see what the Fed has to say about it. So now comes the fun part of the video, my phony headlines. Here are my goofy takes on what you should least expect from housing in the mortgage market in February and May of 2025. First up, Fed hits pause on rate cuts. Mortgage rates fall through the floor. How about this one? Are we there yet? Neutral? Fed? Not sure. Oh, this one's coming. Unemployment breaches 4.5%. Is the Fed too late? How about in 6 months' time? Where are the buyers? Mortgage rates hit 3-year low. And this is my favorite. Powell throws in the towel as Fed chairman. Well, what do you think? Did you laugh? Well, thank you very much for watching this video. I'll be back with another one soon.